You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
What's your most contrarian call for this year, betting against the herd?
I do think lithium is going to do well. So, you sort of Google gigafactories in the United States, and you'll find a map that shows you, 40 gigafactories that are planned or being built. Well, things like Thacker Pass, which hopefully is turned on in 2 years, that's the lithium for one gigafactory.
You are listening to MSE. I'm Bill Powers, and in today's show, you're going to hear from a fund manager that we haven't spoken to in a few years. We're talking about Will Thomson from Massif Cap. The website is massifcap.net. Will, welcome back onto the show. And your fund invests in real things, and you take a long-term, value-oriented approach. So the first question for you today is, where are you seeing value?
Well, Bill, thanks for having me back. It's been a couple of years, a tough couple of years for mining, which represents anywhere from about 25% to a third of our portfolio at any given time. Where are we seeing value today? From a top-down perspective, I think it's really complicated and really hard. I think that for at least the next 12 months, and I definitely felt this way about last year, it's going to be difficult to sort of identify commodities and or trends in commodities that are really supportive of broad exposure to, say, mining or copper or gold. But I do think there will be a lot of catalysts or a lot more catalyst-driven opportunities. And so the places we're looking right now in regards to catalyst-driven opportunities, sort of first in terms of mining, and then I'll sort of go through a couple of other real asset sort of categories, would be the battery metal space. It's really bombed out. And while there may still be some pain this year, from a cyclical perspective, it's bombed out. You've got some people who are getting ready to turn on mines. You've got some people who are getting ready to finance, getting ready to go through permitting, things of that nature. So those types of non-commodity price catalysts are looking interesting in a couple of places, especially in regards to some U.S. focused lithium names. I'd also say, sort of the perennial metal that always offers sort of catalyst-driven opportunities is gold miners. The cycle for turning on a gold mine, much shorter than copper or nickel or anything like that. And so, there are names, juniors, mid-tiers, all of whom are, getting ready to turn things on. One of our favorites, we've been invested for far too long, is Equinox, turning on Greenstone this year, which, is going to be one of Canada's biggest gold mines. And they've managed to mostly stay on budget despite inflation, which was good. They've absolutely stayed on time, which is excellent. So that's interesting. Last year, there was a nice play in Osino, which I know you know quite well, and we were invested in last year. Haven't dug as deep into what the new company is going to look like, but the assets in Namibia, they're going to turn those on relatively quickly. That's a very straightforward mine to build, and so would be optimistic about the potential there. Outside of that, in mining, I think one's got to be really careful right now in picking their sort of spots. And we have some core sort of positions built within some copper miners that we really like, development opportunities, but I wouldn't be particularly optimistic outside of maybe, random drill results that come in. Everyone gets excited about stuff like that. I wouldn't be particularly optimistic. I think the long-term case for copper is still intact. There doesn't seem to be any reason why anyone would, or any strong argument against that. And even this year, copper demand out of China last year, which really drives the ship, was up close to 10%, if I remember correctly. And it's really being driven by top-down policy from the CCP about energy transition. And so even in the presence of sort of a weak real estate market, their copper demand is rocking. So I don't think copper is necessarily a great play for the next 12 months, and names in copper may not move. But, it's probably a good time to start positioning for the latter half of the decade in my mind.
Will, have you held Equinox since I last talked to you a few years ago? You were big on Equinox. Did you hold it through the sell-off?
Yeah, well, we trimmed a position during 2021 or 22. I'm blanking now on which. It sort of peaked at around 15. We trimmed the position there, held on to a core position all the way down, doubled down at the bottom, which is not that far off where we are currently. And now we're sort of just sitting tight on the position that we've got. So, management there is great. They're always available. They're always sort of transparent, or at least in my opinion, particularly transparent about what their plans are sort of going forward, what they're struggling with. They, of course, have great backing in the form of Ross Beatty. So it checks a lot of boxes. I will admit that some of their assets are not the lowest cost in the world. But when one sort of thinks about gold and right now looking for a name with a lot of torque to the gold price, that does have some ability to generate free cash flow when they pull back on the CapEx a little bit, threading that needle, high torque, with the ability to produce, with the ability to execute, with the ability to grow. They're one of the sort of few names I think sort of fit that bill.
And you only invest on the New York Stock Exchange. You don't play the OTC or the venture stocks, do you?
No, we invest globally. Right now I'd say, just sort of looking at the portfolio, in terms of mining stuff, most of it is in Canada. Equinox we do own in the United States, but we used to own it in Canada before it listed in the US.
But only the exchange, the big exchanges like the Toronto Exchange or the New York Exchange, or will you go on the CSE or the TSXV?
No. Yeah, I don't have any problems with any of that. One just needs to sort of calibrate their risk and position sizing and just sort of be a little more cautious. We tend not to invest in anything less than about 200 million in market cap USD. But that's not a hard and fast rule. It's more a rule around liquidity. So if we find something particularly interesting that's smaller and we are confident we can get in and out in a reasonable amount of time with the size we need, we'll play in the smaller equities and off the major exchanges.
Another position you had was Lithium Americas. I remember when we chatted some years ago. Do you still hold that?
So that's another example of a company we rocketed up to just shy of $40, which, two pre-production mines, $40 is $40 a share. And I don't remember what the market cap was at that time, but it went on a run from our entry price of 2.5 or something to that 40. So we trimmed, again, 2022. And then held on to a small position with a primary sort of focus on Thacker Pass and thinking that Thacker would become something interesting. Now they've split the company. We still own a small position in both Lithium Argentina and Lithium Americas, which is Thacker Pass. Lithium Americas we're keeping pretty small. It's still early days. But in terms of sort of the thing about lithium is you got to have the right team who's done it before. The lithium is complicated. It's not nearly, especially on the processing side, and that's where the money's really made, if you will. And so Lithium Americas has got the right team. They've done it before. They've got the right backing. There are some other clay deposits, and Thacker Pass in Nevada is a clay deposit. There are some other clay deposits in the United States that are maybe not, in my opinion, quite as interesting long-term as Thacker Pass and Lithium Americas, but are themselves quite interesting. So Ioneer and Surge Battery Metals would be two that I think are worth keeping an eye on and watching closely. Drill results and sort of grade out of Surge Battery Metals and their clay lithium deposit are quite spectacular.
What about Kazatomprom? I know you had a position in that stock some years ago.
So we haven't owned Kazatomprom for a couple of years now. I mean, the story behind and uranium and our Kazatomprom investment sort of really demonstrate, at least in my opinion, sort of what we like to do, which is find a company with company-level catalysts within commodity industries that we can invest in that we expect to rise regardless of the commodity price action. Kazatomprom, we had watched uranium for 10 years, done nothing, right? Because the story had always been the same. And we just couldn't find a company we wanted to own. In 2017-18, Kazatomprom, must have been 2018, Kazatomprom IPO'd, and at IPO, and sub $30 uranium or something, they were profitable, free cash flow profitable. Their ISR mines in Kazakhstan produce uranium at like $14 a pound, and the stock IPO'd at $13 a share or something, with spot price uranium implying like a, I don't know, $25 or $30 valuation. So we invested in Kazatomprom, not because we had any expectations about uranium price, but because it was just a clear sort of value opportunity, and they were paying a dividend the whole time. We did exit when it hit probably $35-ish a share. That was in 2022, I think. 2022. Last year, at the beginning of the year, we looked at uranium again, couldn't find a company we liked, but did feel like the macro setup for this story about uranium finally coming sort of full circle, and sort of finally being fulfilled with, the supply-demand imbalances. And so we bought the Sprott Uranium Trust. And so we still have that. We've got, it's just shy of a 12% position now, actually, in our portfolio. So it's grown quite a bit.
So what is your take on that then, in terms of investing directly in the commodity via a vehicle like that versus investing in an actual mining company? Could you share a little bit of your thinking here?
Yeah, I mean, when it comes to equities, we never like the commodity price to be the catalyst. We view it as, it's not that it can't be done. We just view it as a little bit sloppy, if you will, in terms of the thesis, right? Because there are all these, let's say you buy a copper company or a copper miner, and it's because you think copper is going up. Well, there are all these other variables: political risk, execution risk, financing risk, all these other variables that get in the way. So you could get your commodity price call completely right, but still lose your shirt because the mine is, I don't know, they don't turn on the mine or anything like that. So we tend to be very company specific focused, and try to find companies where we think all the boats are going in the same direction. But our primary concern is the company. When it comes to having a commodity price thesis, our preference would be to just execute that. If we're going to do that, would be to execute it sort of directly via futures, because then you've sort of got that really clear alignment of thesis and sort of outcome. One of the things that I think results in people losing money in the market is not having as clear an idea of what your thesis is and how that thesis is going to impact the way you've executed your idea, right? Your thesis and your idea, or how you execute it, there's got to be a very clear causality there, because there's too many variables going on. So in the case of uranium, this happens in other places as well, with other commodities at times. Sometimes there's a great vehicle that can save us the trouble of the futures. Never even looked at uranium price futures. I mean, they do exist, but they're cash settled, and I don't know what kind of liquidity there is on those. But in this case, there's a very, very good instrument to execute a price sort of focused idea, and so that's our thought process behind it.
So if you use futures, you're using leverage then, right?
Yes.
So what's your thoughts on how using leverage in the commodity space?
be very careful.
Exactly.
Yeah. I think that, I would just say you've got to be very careful with how much leverage you take.
Do you remember when Donald Trump got elected and what gold did? How it went straight up and then it came straight back down. I mean, I looked at that market. I said, if I was playing that in the futures, I don't even know what I would do.
Yeah, no, I mean, this is why we oftentimes, I'll admit, when we've done something in the past, we've tended to fully collateralize it with cash that we then invest in treasuries. Now, last year, that worked quite nicely, right? The cash earned, I think we earned 5% on the cash all year for the one position that we had. We go back to, not earning anything on cash, which I don't think is the base case. It won't be as attractive. Fully collateralizing it does allow me to sleep a little better at night.
What's your most contrarian call for this year? Betting against the herd.
I mean, I do think lithium is going to do well. I think there's a couple of things. We see all, especially in the United States, we see all these headlines about EVs. And look, batteries are what drive the lithium sort of story, and the battery story is really driven by EVs. Okay, I think we all know that, but just it needs to be said. We see all these headlines about EV this and EV slowing down, sort of demand not there. But EV demand last year still grew at more than 50%. Right? I mean, EVs are selling, and the market is growing, and that's just the United States. Europe and China, it's a completely different story, and those headlines about EV demand slowing, they not only don't apply there, but they're just wrong. And in the United States, yeah, sure, it did slow, but I'm sorry, it slowed to increasing 50% in a year instead of 55 or 60. Granted, that's slowing, but, one's got to be sort of careful about writing too big a novel about what going from 60% per annum growth to 50% per annum growth really means for the underlying commodity. Right now, at current prices in China, you're not really incentivizing much production to come online. I think the Chinese probably underwrite a lot of production within China that is not cost effective. And they certainly look like they're going to do that in Africa as well. But I still don't see them bringing online supply that'll swamp the market. And even then, they're bringing online, lepidolite and these really sort of crummy resources. You look at the United States and sort of and it's pretty easy to find one of these, you sort of Google gigafactories in the United States, and you'll find a map that shows you, 40 gigafactories that are planned or being built. Well, things like Thacker Pass, which, hopefully is turned on in 2 years, that's the lithium for one gigafactory. You look at these plans and you see multiple gigafactories, you need multiple Thacker Passes. You need to really ramp supply. And last year, everyone sold renewables, everybody sold lithium. The sort of shine came off the ESG sort of green story, which I think was more than warranted. I think a lot of that stuff ran, especially on the straight renewable side, wind and solar companies, especially solar. But now it's sort of just gone, it's just gone a little too far in the other direction, if you will. As the market does, it never finds that middle ground. It always overshoots one direction or another. I think it's overshot now in the other direction. So I think lithium's particularly interesting here. I don't think nickel's interesting. I've got one nickel position in Centaurus. We really like the deposit. It's in Brazil, but I will be fully transparent. I am down 60% in that position and just have gotten my ass handed to me. Other battery metals, less optimistic about for this year. But lithium, I do think there are interesting companies, interesting deposits, and interesting macro backdrop.
So of lithium or solar/renewables for the contrarian bet, if you had to choose between those two, you would choose lithium? Because some of the renewable energy ETFs, they're starting to perk up. And I've talked to people that think they're oversold right now. Yeah,
I would still probably choose lithium. I think it's a harder They'll be harder positions to own, if you will, from a behavioral perspective. But I think your risk reward ends up being better. I still think the challenge with a lot of the renewable businesses in my mind is they still haven't necessarily really figured out what their business model is. What I mean by that is solar and wind really are effective sources of energy in the right place. I think the interesting analogy is mining, right? So I live in Charlotte, North Carolina. When I first moved into my house, I walked into the backyard and it was a mess. And I tried to grow grass one year, couldn't grow grass. So I took a soil sample and sent it off someplace, and they were going to tell me what kind of fertilizer I needed. And when they came back, they said, there's iron in your soil. And I was like, okay, there's iron in my soil. Okay. Just because there's iron in my soil doesn't mean I can build an iron ore mine in my backyard. Okay. Just because there's sun in my backyard and wind doesn't mean I can put solar panels and wind turbines in my backyard. People seem to think that just because the sun shines and the wind blows, you can cost effectively and economically put solar and wind there. That's not the case. It's harvesting a natural resource, which means the site really is quite important. I don't think a lot of the renewable companies have yet to figure out their business model such that their capital is on average being deployed into capital and energy efficient locations. It's sort of, again, you look at the Permian in oil, right? And people want to be on the fairway. They want to be on that core territory. This is the same story. You got to find the core territory, and that's where you want to be. And if you start throwing solar panels up just anywhere where you can put them, or wind turbines up anywhere you can put them, the long term is not going to be economic. So some of those guys I still think need to figure out their business model. And so companies like Ørsted, I think they still have some work to do to figure out what they really want to focus on and where they can really deploy capital with, say, offshore turbines, for example, efficiently and effectively. And until they get their business model sorted out, or until I get some inkling that they've got it sorted out, probably just going to sit on the sidelines. We do have a position, and we like it quite a bit, in Siemens Energy, which manufactures, Siemens Gamesa is the number 1, 2, or 3 largest wind turbine manufacturer in the world, depending on whether you're talking about offshore or onshore. While the developers still need to figure out your business model, the OEMs have work to do also, especially on the cost front. But I'd sort of rather sell the picks and the shovels, if you will, into the industry than have outright exposure to it, especially because that outright exposure is so often underwritten by a tax subsidy of some kind, which in my mind makes the business model unsustainable.
Or some view that as lowering the cost of capital, though. So you would not take that view.
Yeah, I would not take that view. And I would not take that view again because Donald Trump comes into office. I don't know if those subsidies will still be there. I imagine they will. But you're making a political bet that the winds, no pun intended, don't change in DC or in Europe, and that if they do, those companies can still make money with their sort of recycling of capital. And it's just not clear to me that with the cost of the equipment, the cost of electricity, and the continuous effort to drive down the cost of electricity, that they can. I think a couple of years ago, we did a study looking at solar supply chains, and we tried to put together the profit pool for a solar value chain from polysilicon production on through to the end use. And I haven't updated the research, but I'd be surprised if it's changed that much. There was just not enough money in the profit pool to go around. Not everybody in that chain could make money. If not everybody in the value chain can make money, it's not sustainable. That was with Chinese subsidized energy that, we couldn't back out what that subsidy would be. So you get the cheapest panels from China, and that value chain still doesn't produce enough such that everyone can earn something. That's a problem.
Part of the argument or counter argument to what you're sharing some of the solar proponents would say, well, the oil industry in the States was subsidized to help it mature to get to where it is. Even the nuclear industry, I meet nuclear people that don't realize that the U.S. government has helped a lot. Go look at the last plant that was built in Georgia. Let's not close our eyes to that.
No, and I mean, I don't argue against the need for subsidies necessarily to help some industries get going. I think anyone that does, to your point, is sort of closing their eyes to a lot of very easy to access information, right? I mean, as you said, the oil industry gets subsidies. Everybody gets subsidies. In the United States, everybody's getting something. The question is whether when you back that subsidy out, at least in my mind, the question is when you back that subsidy out, can you still make money? Oil companies can tend to still make money. Solar and wind, it's more of a coin flip. And I will grant you that I'm sure there's somebody that can, I'm sure there are many people who can present me evidence that I'm wrong. But it's going to be close enough that it's not sort of outside my margin of error, my error bands, right? And even I could fiddle. I remember fiddling with some of the results in that study that we did. And you could swing it one way or the other, but it's still, we're not talking about swinging it such that clearly the lack of profitability is false. It was swinging it enough such that you're sort of like, okay, maybe they can skimp by. I'd rather not. I'd rather not play in that space until they've figured it out.
Another commodity that's out there that wasn't talked about when I was in high school is carbon credits. Now, I've talked to smart people who on the one end think it's a scam, and who on the other end think it's the next best opportunity. Where would you fit within that spectrum?
So we did buy carbon credits in Europe in middle of 2022, I guess. And sold them last year, having not really made or lost money. It just sort of was a push based on our timing. I think carbon credits are interesting in the right market. I think the only legitimate market is really Europe. I know some people talk about California. Haven't really spent a lot of time looking at it, but in Europe, they appear to really be pushing hard and in the grand scheme of things, quickly towards a carbon market that really covers all industries. And at least from my perspective, that's the direction you need to be headed if you want to build a real market around this. There is the liquidity. What I will say is that the regulatory component of that is sort of the most critical thing to understand at this point still. I don't think that, the EU regulations specifically stipulate sort of how the credits come in every year, how many are coming out and being canceled, how many are given away for free. There's quite a very deliberate system put in place. And so if you're interested in carbon credits, those are the documents you really need to dig into because little adjustments here and there as they go along to the regulations can sort of swing the supply and demand in fairly meaningful ways for the marginal price. As I said, we had invested in it at one point. We thought that the market would tighten up. And I still think from a regulatory driven perspective, it is going to tighten. But it just sort of seemed like capital that was going to be very slow moving. And so there was sort of an opportunity cost associated with deployment into it. I think for the next couple of years, it moves slowly because the tightening is primarily regulation driven. And so that,
So the product doesn't exist without the government, whereas copper exists without the government, silver exists without the government.
That's a good point.
So is it a real thing? If you invest in real things, is it a real thing? It
doesn't exist yet without the government.
Yeah.
I think at some point it will in Europe, but for at least the next 5 to 10 years, it's just sort of continuous tinkering and tightening by the regulators.
Mm-hmm. So, Will, your website is massifcap.net. Can you share with listeners what they can find there?
Yeah. So we actually just redid our website. So .net, .com, .org, all of those you can find us at. You can find all our letters going back till 2016 on the website. You can also find blogs, research reports, links to podcasts that we've done, and you can get on our research subscriber list. We send out our letter via the subscriber list. We also send out a couple of blogs, sort of a quarter. We took sort of last year, we took a bit of the year off just because some changes in the business, but we're back at it and, sort of have high hopes to produce a fair amount of research this year that supports the sort of work we're doing at the fund. Deep dives into commodities, energy transition, stuff like that. So it's all available on our website. It's all basically free and open to anyone.
Excellent. Well, I really enjoyed catching up with you, Will. It was a few years, so thanks for coming on today's show.
Absolutely. Thanks for having me, Bill.